Hi, everybody. This is Jeff Fowler with the Apartment Owners Association, and it is great to have you with us today. Thank you so much for being members with us. And man, it's just been so much fun. Last week up at the Bay Area Landlording Power Conference, just such a great time. Yesterday down in San Diego for a doubleheader. And yeah, my name's Jeff Fowler. I'm with the Apartment Owners Association. And there are low fee 1031 solutions that are out there. And so we're going to be talking about that today, and specifically that with a 721 UPREIT. And before we get into that, really our goal is to have the most successful group of apartment owners in the state, let alone the country. And we're doing everything that we can for that, trying to keep the forms updated, trying to give you the best tenant screening tools, and just getting you good information. So if you're not a member, want to invite you to join. It's $97 for the year, and there's a money back guarantee, 100% money back guarantee within the first year. So we want to invite you to that. And you may have missed it on Tuesday. We had Dennis Block speak about security deposits, and so that was really a good time. You can catch it on our YouTube channel. If you're on AOAUSA.com right now, there's a little YouTube icon, and it will take you directly to our channel, and you can subscribe and hit the notification bell. Sometimes we do stuff there that is live. Other times there are things that are just we just post. But anyway, so yeah, so here we go. Let's get into this thing. We want to shout out to our sponsor, Origin Investments. They're a private real estate manager that helps high net worth individuals, family offices, and advisors grow wealth through tax efficient real estate solutions. They build, buy, and finance multifamily projects in fast growing US markets and offer 1031 exchanges through their Origin Exchange platform. In 2023, they launched Origin Credit Advisors, providing yield-focused multifamily debt investments. And with Origin today, our speaker is with Origin, and with over a decade in the alternative investment industry, he's helped syndicate over $10 billion in commercial real estate, including $500 million in 1031 exchanges. Our speaker holds an MBA from DePaul and a bachelor's from Purdue. He's a CFA charter holder, and lives in Elmhurst, Illinois, with his wife and 3 kids. I think okay, yeah. Anyway, so it's my pleasure to introduce to you Michael O'Shea. Thanks for jumping on this thing with us.
Yeah, well, thanks, Jeff, for the kind introduction, and happy to be here again. I think that's a nice introduction to Origin and what we do, and I think you hit the nail on the head. We are a low-fee provider of DSTs for clients that are looking for a 1031 exchange. There's quite a bit that we do outside of that scope as well. But for the purposes of this call, I think what we were going to hit on is 1031 exchange, 721 UPREIT. I want to go through some of the rules of the road. I think there's a lot of complications that get involved with 1031s, and maybe just clarify some things that people aren't as aware of. I want to give you a little bit of background on who Origin is, and what we do, what we're good at, how we're different, what our value add proposition is, and then really get into our structure, how this can benefit you. One of the things that is a problem with real estate is that people enjoy the cash flow. We like the depreciation. We like the appreciation of the assets, but it's a lot of manual labor. It's a lot of work. It's a lot of time. It's a lot of stress. And what you're seeing in California is there's a lot of government intervention as well. So even if you're running your properties quite well and doing a good job, you can have new propositions that come and change the landscape right underneath your feet. So a lot of people are looking for a way to exit out of their real estate in a tax-free way and to unburden themselves with the management that's involved. So we've got a pretty unique solution there that we'll talk about today. All right, so getting into the presentation, Jeff, are you seeing this? Okay, yeah, I can see it on the screen now. So,
Yeah, yeah, perfect. Crystal clear.
yep, a little bit about Origin. We are based here in Chicago, which is where I sit. We're a firm that started 17 years ago, and we were founded essentially as a family office. Our two founders, Michael Episcope and David Shear, they were derivatives traders at the Mercantile Exchange here in Chicago. Michael was actually named top 100 trader in the world twice by Trader Magazine. And so these individuals built substantial wealth. And when they got out of the trading business, kind of in the early 2000s, they looked around the market and, how can we preserve and protect our wealth? And what they found they didn't like in terms of fees, alignment of interest of other managers, et cetera. And so they pooled their capital together and they built Origin as a way to preserve, protect, and grow their capital. The way we think about markets, coming from their kind of derivative trading days and the way we think about risk, has proven to be very, very successful. So we've been a top decile performer in the private market since our foundation. And so because of that success, we've had a lot of investors come on. It started as friends and family like any other business, but we've now grown to over 4,000 individual investors and over 80 financial advisory firms that invest their clients' capital with us. So you can see our markets. We are a very, very data-driven company. We used AI before everybody was talking about it. Back then, when we built it, it was called machine learning models. We felt like the data wasn't very good in commercial real estate in terms of its predictive power to determine whether rents would grow in certain markets. And so we built a proprietary system called Multi-Lytics. We still use it to this day. It takes in over 9 billion data points a month. And you could think of it as a large regression analysis that helps us determine which markets are going to grow rent the fastest over the next 5-year period. So these are the markets that we invest in. Obviously, we don't invest in Chicago, even though we sit here. We don't invest in New York. We don't invest in California. We invest in 12 growth markets, sort of through the smile of the United States, the Carolinas, through Florida, Texas, and the Front Range of Colorado. And we have a little bit over $2 billion of assets under management. Last thing I would mention about Origin, we only invest in multifamily real estate, only do apartments. We don't invest in shopping centers or industrial or office space. We focus on 12 growth markets throughout the Sun Belt, and we only focus on multifamily. So as Jeff kind of had a nice introduction, I've been doing this for 18 years in the DST space. And when I came over to Origin, the goal here was to build a better mousetrap. DSTs are a great solution in terms of exchanging out of day-to-day management and exchanging up into more institutional real estate. However, there's lots of fees inside of a Delaware statutory trust and some operational risk associated with it. So when I came to Origin, we wanted to start from scratch, go directly to real estate owners, and build something that's going to have lower fees, more transparency, putting more of your money to work in real estate and generate better investor outcomes. So what we're going to do here may be rudimentary for some people. I'm going to go through this pretty quickly. This is an hour-long presentation that I do for CPAs. We're going to try to get through it in about 20 minutes here. So a lot of this stuff I will go through quickly. I will tell you, if you've got a specific case or if you want me to talk to you about something a little bit more in depth, we did put my booking link up on the screen. So you can go ahead and click that link, find a 30-minute time frame that works for you. And we can discuss your actual case or any of these rules that we're going to be going through. So when you hear 1031, that's simply section 1031 of the tax code. It essentially says, if you sell real property and you follow certain rules and exchange it for like-kind property, it's not seen as a sale and a new purchase. It's seen as an exchange of assets, and therefore no taxable event has happened. So the 1031 has become one of the most powerful tax tools in the rule book for people that own appreciated real estate. And when you do sell your real estate, the tax bill in a lot of cases is higher than people expect. Most people just apply a 20% long-term capital gains and say that's what my tax bill would be. That's true. That's from your cost basis to what you sold, but anything you've depreciated is taxed at 25% as a recapture. You've also got state capital gains tax or state taxes. So if you're in California, that's almost 14 additional percent. And if you're above the NII threshold of $250,000 of income, for most people selling a substantial piece of real estate, you're already above that. That's another 3.8%. So you can just see in this simple model here, bought a building for 600, sold it for 1.2, you've depreciated a little bit. You've actually got almost $307,000 of taxes due. So $893 in your pocket versus 1.2 million going back to work for you and building wealth and generating income. So you can kind of see just in this simple example how powerful it is. I'd encourage you to check out our website. We have a calculator that's built in. And one of the things I like about it is right at the bottom, it says, email me a copy of this, a summary, and it'll generate a one-page PDF that'll be emailed right to you. And you just put in what you sold it for, what you bought it for, what you're selling it for, your depreciation, your leverage, and it will kick out an estimated tax bill. There is a QR code here. So if you want to take a picture of that, that will take you actually directly to our website so that you can fill it out. You can also go to origininvestments.com and click on the Origin Exchange tab, and that's going to have just about everything we talked about today. Okay, so these rules, this is the big one. You know, everybody when I talk to about a 1031 exchange says, you have 180 days, right? And I say, yeah, that's the 180-day rule. But really, there's a 45-day rule that's super important. So from the time you sell, you have 45 days to identify a replacement property. And in those 45 days, you can identify up to 3 replacement properties. After that 45 days is up, you have to close on one or all of the properties that you identified. So when people say, do I have 180 days? It's a little bit more nuanced than that. You really have about 45 days to find replacement property, and then another 135 days to complete the exchange. So we'll go through a couple of these requirements in order to facilitate a 1031. First of all, it has to be like-kind to each other. That doesn't mean you have to sell an apartment and roll into an apartment or raw land for raw land. It simply means that it has to be real property that's held for investment purposes or for use in a business for the same. So you could sell raw land and you could roll it into a hotel. 2 of the things that you'll see there on the left-hand side, one is a TIC interest, one is a Delaware statutory trust. A TIC is a tenant in common. A Delaware statutory trust is what Origin offers, and it gives you the ability to pool capital together and buy a much larger property. TICs will give you that same ability, but there's some downsides to TICs, namely that every major decision has to be unanimous. So if you have 20 people in a TIC and 19 people want to sell and one doesn't, you're stuck in the TIC. So the DST puts all of that decision-making in the hands of the sponsor, and it's a much more streamlined process. So there's lots of benefits to DST. I'll talk about them in a second. You used to be able to exchange personal property and collectibles. That was done away with in the 2017 Tax Cuts and Jobs Act. But if you own a partnership that owns real estate, the partnership interest is not exchangeable, et cetera. REIT shares don't qualify. It has to be ownership of real property. If you do have any of these that you're selling, inventory, personal property, collectibles, REIT shares, stock, you can now invest into an opportunity zone fund. So opportunity zone funds were created by the Tax Cuts and Jobs Act, and those were meant to replace this on the OZ. At Origin, we also syndicate opportunity zone funds. We're one of the largest syndicators of OZs. So I'd be happy to talk to you about that if you have non-real estate capital gains. The second rule is that you have to use a qualified intermediary. And this one is fairly set in stone. When you do a 1031 exchange, you can never take constructive receipt of the proceeds. The money cannot go into your account. So before you sell your building, it's very, very important that you set up a qualified intermediary account. You could think of them as sort of an escrow agent that holds the money on your behalf during that 180-day window. I mentioned earlier that you have to identify up to 3 properties. You would identify those properties with the qualified intermediary. So they're a very important part of the process. If you don't have a QI that you work with, I'd be happy to make some recommendations to you there. There's many, many QIs that I work with over the years, and we are not a qualified intermediary. We don't act in that capacity. This comes up all the time. You have to have continuity of title. It has to be the same taxpayer that's exchanging real estate. So because a lot of people own real estate through an LLC or a partnership, in this case where you've got ABC members of LLC, if A wanted to do an exchange and B and C didn't, A couldn't sell his interest in the LLC and then exchange it, right? Because what is A selling? He's selling LLC interest. That's not real property. The LLC is who owns the property. So they would have to sell the property and they would have to be the buyers of the replacement property. A, B, and C would stay members. So how do we solve this if A wants to do an exchange and B and C don't? Well, the most obvious one is you do a partial exchange, where the LLC will do the exchange for a smaller amount. Whatever they don't do the exchange on is taxable. So then B and C take those after-tax proceeds and they are out of the LLC. They are no longer members. You can also do what's called a drop and swap. You can drop it out of an LLC and into a tenant in common, where now each of the members will own an interest in the real property. We would recommend doing that well before you sell. If you are going to do a drop and swap, you can't do that, a month or two in advance. You should consult with a tax advisor if you're considering that, but that is something that you can't do basically at the same time. The last one is our solution, where you're doing a 721 UPREIT. In that case, the LLC would do the exchange. You would be upreit into a diversified portfolio of a partnership. And once you're in that partnership, you can simply retitle the ownership. So that's something that we'll talk about in a second. All right, the last couple ones all sort of rhyme with each other. So we'll just do them at the same time. When you do a 1031, you have to replace the mortgage debt on the property. You have to replace the full value of the real estate you sold, and then you have to roll 100% of your equity in order for it to be a tax-free exchange. So the easiest way to think about it is you have to roll all of your cash proceeds from the sale. Anything you put in your pocket is taxable, and you have to replace the full value. If you sold for $1 million, you have to buy for $1 million or more. So let's just do a couple examples where you don't complete an exchange. So on the left-hand side, here's our example. We're selling for $1 million. We have a 40% loan on the property. So after we pay off that $400,000 mortgage, we have $600,000 of cash. So what you do is you go and find a property that's worth $1.25 million. And you go to the bank and you say, hey, will you guys finance this for me? I'm using it as my replacement property. And they say, sure, we like that asset. We'll give you 60% LTV. We'll give you a $750,000 loan. So you say, great, I've gone up in value. I went from $1 million of real estate to 1.25. So I don't even need to put all my cash in. I'm going to put in 500,000. I'm going to keep 100,000. So because you failed to roll over all of your equity, this would actually be taxable as cash boot in this situation, even though you've gone up. So opposite example, let's just say you find a property that's worth 600K, and the rule is that you have to roll all your equity. So you don't take on a new mortgage, you buy the $600,000 property, and you relieve yourself of this $400,000 of debt. Even though you've rolled all of your cash, this is actually still taxable. So you have to do both. So here's a couple ways that you can solve those problems. So let's just stick with that same example where you rolled $600,000 into a property. Well, number one, you can add leverage. So here's your same equity check, $600,000. Sorry, went ahead on the slide. Here's your same equity check, $600,000. You've added some debt. Let's say you're at 55% loan to value. Now you've assumed this loan, 733, and you've got 1,333,000 of real estate. So you've gone from $1 million to 1.3. You've rolled all of your cash. This would be a tax deferred exchange 100%. Your second option is to add cash. So let's just say you don't like a mortgage. You don't want to have any debt. The problem is you have to have $400,000 of cash in this situation. But if you do, you could roll your $600,000. You could add $400,000 of cash, and you've just bought $1 million of real estate. So if you don't meet the 1031 requirements, you could either add cash or add leverage, and those will solve your problems for you. So Delaware Statutory Trust, we love these deals. There's a full revenue ruling on this. It's 2004-86. It says an interest in a DST should qualify as real property for the purposes of a like-kind exchange. So this allows investors to pool their capital together to buy a much more institutional quality property, i.e. de-risking your portfolio. So it allows you to exchange up into higher quality real estate. It allows you to exchange out of the day-to-day management. You can see here a couple pictures. These are in Origin's portfolio. These are not current DSTs that we're offering to the marketplace, but our DSTs would look very, very similar to this. If you went to our website, origininvestments.com, and you clicked on investments, and then you clicked on Nashville, Queens, you would see our current DST. It's an $84 million building in Nashville, Tennessee. That is open right now if you wanted to invest into it. So this just gives you an idea of the institutional size and scope. The problem with DSTs is not the structure or the assets. The problem is the fees and the amount of hidden fees. So when you do a Delaware statutory trust, you get a 250-page PPM. In that PPM, there's going to be a lot of fees. And if you don't ask, if you don't read, you're going to be subject to those fees. Some of those fees might be selling commissions to brokers. It might be a finance coordination fee, a dealer manager fee, disposition fee upon sale, a managing broker dealer fee. They all sort of add up, where the traditional Delaware statutory trust might have 10 to 15% fees on the front end load, meaning if you put $1 million into a DST, you might only be buying 900,000 or 850,000 of real estate. And we think that's going to lead to poor investor outcomes. It's not the type of deal that our principals would put their own capital into. And so when we made Origin Exchange, we eliminated all of these fees. You can come directly to Origin. We are a real estate operator. We are not a broker. You can come directly to us, cut out that middleman, and save a tremendous amount on upfront fees. We're very open about the fees that we charge. We have an acquisition fee when we buy the property. It's typically 1% of the purchase price. And then we get reimbursed for some of the organizational and offering expenses, which you could think of as like putting the legal documents together and printing and shipping and just the costs of getting the deal off the ground. So whereas the average DST might be in the 10 to 15% range, we are closer to a 3% total front end load. Very institutionally priced. We think it's going to lead to better investor outcomes. So that's where most 1031 companies stop. You go into the DST, and then you stay in the DST until it sells. And then you do another 1031 exchange, and then you do another 1031 exchange. And that philosophy is called swap until you drop. The challenge with that is a lot of them. Well, number one, you still have idiosyncratic risk or single asset risk. So that means you own a single asset. A couple of years later, you roll into another deal. So you always own a single asset. All of your marbles are in one basket. The second problem is operational risk. So every couple of years that it rolls over, what is going to be available? Can you match your loan to value? Do you like the deal? So every couple of years, you have to do a 1031 exchange again, and you might end up in a property you don't like because you've got 45 days. And then finally, the fees. So those fees I just talked about, if you use that swap till you drop strategy, you're going to have to pay that 10 to 15% load every time you roll into a different deal. One of our core thesis here at Origin is that one of the best paths to long-term wealth is to stay invested in risk assets for the very long term without the frictional cost of taxes and transactional fees. And so our exit strategy allows you to do exactly that. So we utilize a different section of the tax code for our exit, and that is called Section 721. 721 is a contribution of real property for a partnership. And you see this with institutional investors, where maybe they'll sell a big apartment building to a REIT, and in exchange for that apartment building, they'll get operating partnership units in the REIT. Now they're diversified across this larger portfolio. On a smaller scale, when we're working with individual investors, we utilize a two-stage 721 exchange transaction. We got a lot of people that would call us and say, can I do a 1031 into your income plus fund? And the answer is no, because they're not like kind to each other. So the way our process works is you sell your property, you do a 1031 exchange into a Delaware statutory trust. If you were doing it today by going to the Nashville Queens Delaware statutory trust. And then 2 years from now, our income plus fund has a right to acquire your asset. And if they utilize that right and acquire your asset, you'll receive operating partnership units under Section 721 that would be tax-free. So now you'd be rolled into a diversified portfolio. So think of it like owning a tech mutual fund instead of owning IBM stock. You generate higher income because now we're no longer in DST. We're in a fund that's non-constrained, and we can generate a higher level of return. And then as far as estate planning goes, you could pass this on to your beneficiaries with no burden of management. It's easily divisible, and you still get that same fully stepped up cost basis at death. So a very powerful estate planning tool when people are starting to think, who is going to manage this real estate when I'm gone? Finally, Charlie Munger, just a quote machine, Buffett's right-hand man. He passed away at Berkshire Hathaway. One of his quotes I've always liked is the first rule of compounding is to never interrupt it unnecessarily. Let things grow and let the interest compound on top of other interest. So this is just a simple chart that shows three options. You have $1 million capital gain. You either pay the taxes of $300,000, or you invest it into a swap till you drop, or you invest it into a 721 UPREIT. The red line is basically you have $1 million, you pay $300,000 in taxes, so now you have $700,000 left. Well, let's just put that in a market portfolio and let it grow. The blue bar is let's put the full $1 million into a 721 UPREIT, and the gray bar is let's put the full $1 million into a DST. The blue bar and the gray bar are earning the exact same rate of return. They're both earning a 10% rate of return. The only difference is you pay the same fees here, even though our fees aren't so high. I modeled the same fees, 10% load here. And then every 5 years, you pay that 10% load again to get into a new DST. And so you'll see the difference here is a 23% increase in wealth by using the 721 exchange strategy. And the problem with DSTs is this investor on the gray bar would normally be very happy. I put in $1 million, I turned it into $3 million. Well, it could have been $3.8 million if you would have just kept it invested. So that's really what we want to get across. And then obviously, you're never going to catch up if you pay taxes. By eliminating that, $300,000 right off the bat, it's too much of a hole to put you in to ever sort of catch up to the tax advantage strategies that are out there. So like I mentioned, trying to go fairly quickly through this process. So I'll just kind of wrap up with Income Plus Fund. I know I mentioned this is the fund that would have the right to acquire your DST interest. And so if you're considering doing a 1031 exchange with Origin, I like to say that you date the DST, but you actually marry the Income Plus Fund. This is a fund that you could be in for a very long time. It's a fund that invests in multifamily real estate only through those 12 markets that we've identified through data as having the highest potential growth rate. And it's meant to be income plus growth. So we're targeting a 9 to 11% annualized rate of return. Roughly, the easy way to think about it is like a 6% distribution, 4% growth. That gets you to about a 10% annualized rate of return. You could either reinvest the dividend if you're still working, or you can take the cash flow if you're in retirement and need the income. So you could turn that offer on at any time. We're very, very particular about multifamily. If you look over the last couple decades, multifamily is the best risk-adjusted return of any asset class of the four major food groups. And it's a need. It's not a want. And we are severely underhoused in the United States. So we're very, very bullish on multifamily and rent growth, especially in the markets that we focus on. The last thing I would mention is kind of the tactical nature of our portfolio. So a lot of the larger REITs out there, they're only common equity. It means you're buying beta, you're buying the market. So if interest rates go up, the value of the assets goes down. At Origin, after COVID and the kind of 5 anomalous years that we went through, we didn't buy a single property because we saw how crazy it was getting with Silicon Valley Bank going out of business and COVID and all the restrictions and interest rates going up and quantitative easing. So we really paused. But in that time, we switched to being a lender, and that really protected the downside. So while most publicly traded REITs and non-traded REITs have been down significantly in the last 12, 18 months, we've actually had positive returns. And we are now switching back to focusing on equity. We think buying assets is going to have an outsized return going forward. So that tactical portfolio will protect you on the downside. Cumulative growth, this is all on our website. But just to kind of compare the Odyssey Index, this is from NACREIF. Sorry, switch the slide again. The Odyssey Index, this is sort of an index of how a privately held real estate investment would perform. And you can see this is mostly institutional, but if you kind of compare what the markets did versus what we did, we again really protected the downside and captured some of that upside. So we've performed quite well going through this sort of anomalous market, and we think very bullishly about the multifamily market going forward over the next 5 years. So that's it. We think by doing an investment in the Origin exchange, you're going to put more capital to work by paying less fees, and you could deal directly with the real estate company, exchange up into institutional quality assets. You'd be 100% focused on multifamily, which has the highest risk-adjusted return. And then you go into the Income Plus Fund, which has the tactical strategy to kind of change its focus depending on different market environments. As I mentioned, there's kind of a lot to this. And so if you'd like to schedule a quick call, you could either scan this link. I think my qualified link is up there on the screen as well. You can click that and find a time. You can also just email me. It's first initial last name, moshea@origininvestments.com. And I'd be happy to walk through any questions that you might have. So thanks, Jeff. Really appreciate the time.
Thank you, Mike. Appreciate you too. And we do have a question here from Charles Ting, and I think it's just like totally one of the most important questions. When are capital gains taxes due during the 1031 to 721 life cycle?
So as long as you follow all the rules, which I mentioned, prior, there will be no capital gains taxes due. This is a deferral of taxes. So if you do it right, you could think about it as no taxable event occurring. So there's no state taxes due, no federal taxes due.
So when if you're pulling out something from the 721, pulling out a certain amount of money, that there's not a capital gains tax on that?
Oh, sorry. I think maybe I misunderstood. Yeah, like down the road, if you own the Income Plus Fund and you sell it, that would be taxable. Is that what you're asking?
Yeah, I think that's what they're saying. So basically, there's no taxable event until you actually access the funds from the Income Plus Fund. Is that what I'm hearing right?
That's right. Here's the way I summarize that is when you own real estate, if you ever sell it and put the money in your pocket, it's taxable. But at least with ours, you can make smaller withdrawals. So if you own $1 million building, you either sell it for $1 million or you don't sell it and you have $0. With us, if you had $1 million position in the Income Plus Fund, you could redeem $100,000 and keep $900,000 in the fund. And potentially you'd have to talk to your CPA, but let's say in that same example, you had a $200,000 cost basis in that $1 million property. Well, if you redeemed $200,000 or less, that's below your basis. That could be a tax-free withdrawal. So this could allow you to actually access some cash that wouldn't be accessible if you owned real estate.
Yeah, that's great. And I think a lot of people, they're really aware of compounding interest, but not maybe so aware of how detrimental taxes are to your investment. I mean, it's worse than a flood, I mean.
Yeah. I think especially if they're, sort of not shown up front, right? Like you sell this and you roll into this and your statement shows higher, but you're actually buying less real estate, right? So that does eat away at your returns if you're continuing to pay high fees.
Right.
Warren Buffett talks about, I like Charlie Munger and Warren Buffett and all their quotes. I think Warren Buffett talks about fees being similar to a jockey on a horse. And if you didn't have a jockey, you'd win the race every time.
All right, here we go. Jay Lentz, does the 721 have the option, but not the obligation to buy the current Nashville DST?
Correct.
Okay. And then Ben, how liquid is the 721 UPREIT in the Income Plus Fund?
So once you roll into the Income Plus fund, you'd get to participate in the redemption schedule of Income Plus. And I should say, Income Plus is meant for cash investors. We have new cash investors that are coming in every month. By doing the 1031, you're sort of coming in the back door through the DST interest. So the redemption schedule is a 5-year sliding surrender charge. So let's say you're a cash investor. The first year is illiquid. After 1 year, you can get out at 92.5 cents on the dollar. After 2 years, 95 cents on the dollar, 97.5, and then 100, right? So after 5 years, you get that full redemption. When you do a 1031, you get credit for time served, right? So you have 2 years in the DST, and then 1 year in the Income Plus fund that's illiquid. That's the 721 rule. So your first shot at liquidity would be after 3 years, and it would be at 95% of net asset value. The fund is allowed to redeem up to 5% of its outstanding shares in any given quarter, 20% in any given year. So a $1 billion fund can redeem 50 million a quarter, 200 million a year, not 5 and 20 of your investment, but of the whole fund. So we have had no gating challenges. Anybody who's wanted to get out of the Income Plus fund has been able to get out, very dissimilar to a lot of non-traded REITs that have had to sort of gate. And I think the main reason is we have the right kind of partners, right? Like we have things on the front end that sort of turn some people off. You have to be an accredited investor to invest. Our minimum investment is $100,000. We have the 5-year kind of sliding surrender charge. So we have the right type of partners that when they get into our fund, they realize it's a long-term investment. And so we really haven't had any challenges with having to gate or not let anybody out of the fund that wanted to get out.
And here's maybe the last question we have here on Westbourne. What is the tax consequence to heirs taking funds out of the 721? So you mentioned swap till you drop.
Mm-hmm.
So how would you answer this? What would you say to this answer? How would you answer them here?
Well, I have to be careful not to give tax advice. So you'd want to consult your own tax advisor. But this has the same result as owning a DST or owning the property that you own today. It's a fully stepped up cost basis at death. And every state is a little bit different. And if you're holding in a trust and the size of your estate all comes in, but you get a fully stepped up cost basis, which your heirs could either sell it and pay very little taxes. A lot of times they'll just keep holding it and reinvest the dividend, right? So if they're going to work for another 20 years, there's something called the rule of 72. And that says you take the rate of return that you get and you divide it into 72. That's how long it takes something to double. So if you inherit a building and you've got 7 years left till you retire and you inherit $1 million and that earns a 10% rate of return, it's going to double every 7.2 years. So by the time you retire, that $1 million is worth 2 million, right? Now you turn on the income, 2 million times 6% is 120,000. So now it's generating nice income for you throughout retirement. So there's many, many ways you can utilize it, but it's all simple. There's no burden of management.
All right, here's Sean. How locked in is the DST or UPREIT? Could the current administration or a future administration alter or take away the DST or the UPREIT?
Congress can do whatever they want to tax law. I know 1031 exchange has been on the chopping block many, many times. It's been around since 1921 without being touched. The nice thing about our strategy is once you do a 1031, you no longer care if 1031, well, we don't want them to go away, but it wouldn't affect you if 1031s went away because the next thing you're doing is a 721. And once you're in the Income Plus fund, there's no more transactions to do. Again, it takes away that operational risk. You just own partnership interest, right? So you don't have to rely on any tax law going forward. I have never heard of 721 legislation talked about at all. It kind of flies under the radar, so I wouldn't expect it to be touched. But 1031 they do bring up from time to time.
All right, Charles, expected rate of return for DST and 721 UPREIT.
Yeah, and if we had more time, I'd put a spreadsheet up, or if you want to book a call with me, I can show you. But the DSTs, you can think of them as very low cap rate, low risk type of investments. So they'll probably generate cash flow in the low 4s. and the total IRR of your 2-year time horizon would probably be in the high single digits, maybe like an 8-9% rate of return. And that's for 2 years. And then once you go in the income plus fund, we expect that return to be between 9 and 11%, 6% cash flow, 4% growth.
Gotcha. Hey, Michael, thank you so much for sharing with us today.
Absolutely. Thank you so much for having me. Really appreciate it.
All right. Well, thank you everybody again for joining us, and hope you have a great, it's not quite the weekend yet, but hope you finish your week off strong and have a great weekend. Take care. Bye-bye.
Bye. Thank you.